Hey, what's going on? It's Nick here from Ways of Wealth. Thank you for tuning in. It's week 24 of the market recap. And if this is your first time here, we highlight key events that happened in the market over the past week. So make sure if you learned something new to hit that thumbs up button for me. It definitely helps me grow. And make sure to subscribe. We do this every single week. We have an excellent episode lined up this week. We're going to be talking about Hertz and if Robinhooders can make the company come back from bankruptcy. And we're also going to be talking about Jay Powell and the Federal Reserve. They set some interest rates this week, and they also talked about the economic situation right now. So got a great one lined up. All right, let's dive in. What a week on the markets. We saw the NASDAQ climb over 10K, the first time ever in the index's history. We also saw a pretty big pullback that happened on Thursday. You know, it's kind of crazy to think. The bulls are thinking it's a consolidation. The bears are thinking it's the market trying to find its true price and it'll continue to go down. And we have CNBC out here calling it a kangaroo market. A what? I've never heard that one before. If you've been catching any of the headlines lately about the market or watch any of my previous market recap videos, you've heard me discuss the younger retail investor, or some people refer to them as Robinhooders. Now, the younger retail investor has had the largest impact of the economy coming off of the March 23rd lows, you know, participating in that 44% gain from the lows that we've seen. And they're getting some slack lately from the older investor who's giving them some shots for investing in Hertz, who has recently filed for Chapter 11 bankruptcy. Hertz originally filed for bankruptcy on May 22nd and have since been notified on Thursday that the New York Stock Exchange would delist ticker symbol HTZ. Now, they have since appealed that decision by the New York Stock Exchange, and it is currently giving them a little bit of a lifeline, as in the interim they've gone out and got a favorable ruling by Judge Mary Walrath to say that they can issue an additional 250 million shares, which should bring in an additional $1 billion to the company. This type of secondary offering is completely unheard of when it comes to a company that has filed for bankruptcy. And as of Friday's data, it showed 102,000 users of Robinhood own shares of Hertz. Now, where the criticism stems from is the fact that they're holding on to what is essentially worthless stock. If this secondary offering doesn't work out, it will be the bondholders that are the biggest benefactor, the biggest winner of this scenario, because that extra $1 billion that the company will bring in is not going to go to the common shareholder. It's going to go to the bondholder and other creditors that are in line in front of the common shareholder. So what a lot of older investors are saying is that, why are you buying a stock that is essentially going to be worthless? With that being said, the older investor has no confidence in the younger investor whatsoever, but I came across a paper from DePaul University which shows that it is actually a hedge fund strategy to invest in companies that have recently declared bankruptcy. The brief snippet shows hedge funds are becoming prominent players in bankruptcy proceedings. In fact, some experts have stated that hedge fund involvement in Chapter 11 cases has become pervasive and extremely active. From a hedge fund's perspective, a distressed company is an investment that can create above market returns. Hedge funds are increasingly interacting with insolvent debtors to turn an investment into a quick profit. Move over, Warren Buffett. This week, we also saw the head of the Fed, Jay Powell, provide an update, and while he seems content with the Federal Reserve's actions to date, he also gave a bleak outlook of the current economic situation.
Moreover, despite the improvements seen in the May jobs report, unemployment remains historically high. Weak demand, especially in sectors most affected by the pandemic, is holding down consumer prices. As a result, inflation has fallen well below our symmetric 2% objective. Indicators of longer-term inflation expectations have been fairly steady. The extent of the downturn and the pace of recovery remain extraordinarily uncertain and will depend in large part on our success in containing the virus. We all want to get back to normal, but a full recovery is unlikely to occur until people are confident that it is safe to re-engage in a broad range of activities. The severity of the downturn will also depend on the policy actions taken at all levels of government to provide relief and to support the recovery when the public health crisis passes.
Powell also touched on credit markets, where the Fed has gone in and bought bonds and provided liquidity, and that's kind of one of the reasons why the market is at where it's at today with the statement, "Don't fight the Fed." Now, what I found most interesting was Powell discussing the mortgage-backed security. Now, if you remember, the mortgage-backed security was one of the culprits of the 08-09 Great Recession, and let's have a listen.
Since March, we've been purchasing sizable quantities of Treasury and agency mortgage-backed securities in order to support the smooth functioning of these markets, which are vital to the flow of credit in the economy. Our ongoing purchases have helped to restore orderly market conditions and have fostered more accommodative financial conditions. As market functioning has improved since the strains experienced in March, we have gradually reduced the pace of these purchases. To sustain smooth market functioning and thereby foster the effective transmission of monetary policy to broader financial conditions, we will increase our holdings of Treasury and agency mortgage-backed securities over coming months, at least at the current pace.
On May 21st, I came across a chart that I posted to my Instagram account. So if you're not following me, quick plug, go follow me now. And this showed that the Federal Reserve had already this year in 2020 purchased $178 billion worth of mortgage-backed securities. Now, where this is a little bit concerning is at the end of the video, he mentions that the Federal Reserve will continue to buy them at its current pace. Now, if we take a look at the chart, it shows that we have already surpassed the level of purchases of mortgage-backed securities by the Fed than we did in the Great Recession. And in the video, Powell mentions that they aren't done yet. Either we've learned from our mistakes or this is a shoestring economy. I'll let you decide. We also learned that the Fed is keeping the interest rates near zero till 2022. And when asked, Powell mentioned that he was not even considering raising the rates one bit. Now, if you remember in the previous videos, we touched on negative interest rates in the market, pricing that in towards the end of Q4 2020. So as of right now, there's no change, but it'll be interesting to watch this moving forward.
It's so far, it's a good response and it's having a big effect. You get to the question is, it's big. Everyone can see that it's big. Is it going to be big enough? And that is a question. And the question from the question that I've been concerned about really is this issue of longer run damage to the economy. We're doing a fair job of getting through these first few months, more than a fair job. The question though is that group of people who won't be able to go back to work quickly, what about them? And that could be many millions of people, who worked in parts of the economy that will be the slow ones to recover. And, we want those people back in the labor force. We want them getting jobs. So, and they're going to need, probably will need further support. So I would just say this. It's possible that we will need to do more, and it's possible that Congress will need to do more.
It is a positive that the quick monetary and fiscal action that was taken have helped the markets inflate back up to levels they were previously. But my concern is that we are kicking the can down the road. There are underlying problems that will only be impacted by future generations. And, although I don't want to do Jay Powell or, Tiff Macklem's job in Canada, I definitely think that we should stop buying the junk bonds or buying risky assets that are keeping the market afloat. I think that For true economics, we have to let prices fall to where they fall, and it helps us recover and recover stronger. But that's obviously, above my pay grade, and I don't have the appropriate solution, but it's something that I am definitely concerned for moving forward. That's all this week for the market recap. Thank you for tuning in. I appreciate it. And remember, if you learned something new or you enjoyed the video, please give me a big thumbs up. It helps me grow. If you haven't, make sure to subscribe, turn that notification bell on. We do this every single week. Thanks again for tuning in. Have a great week on the markets. Happy trading.